Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have Zachary. Okay, I'm gonna ask you to pronounce your last.
Right, don't worry.
Streit.
Streit. It's a weird German spelling.
Okay, I want to say Street, but it's Streit. All right. Well, Zachary, it's great to have you. I want to know how you got from LA to New York City and then back again, and all of a sudden you're in commercial lending. So give me a little clue here how that all happened.
Sure. Definitely it's been a little circuitous, but I grew up in LA and I always wanted to spend time in New York, and so I ended up moving to New York after high school and spent the first decade of the 2000s there. I just thought it'd be a cool place to kind of go to school and meet people and learn different things to grow up a little bit. So I spent 10 years in New York. I did undergrad there. I did law school at Cardozo. I did business school at NYU in their Masters of Real Estate program. And then I worked for 4 years for a big UK life company in one of their equity investment groups. And I did that during the GFC. So it was a pretty amazing time to have a job, an interesting time, a very tough time. And I learned a ton throughout that experience. I basically learned who all the big commercial real estate GPs were, and kind of just the general landscape. I moved back to LA in 2011 because I really wanted to be more on the deal side of commercial real estate, and I hadn't met a spouse. And a few months after moving home, I met my wife, which is awesome. And I spent the first, let's say, 6 years of my career back in LA as a lender on the lending side. So I touched the equity side of the business for 4 years, the lending side, the principal lending side for 6 years, including at Colony Capital. And then I spent the last 10 years as a debt capital advisor. And I kind of decided that, you know what, I wanted to do something very entrepreneurial. I wanted to be able to arrange all types of financing, not just equity or just debt, but both. And within debt, everything: land, bridge, construction, permanent financing, all asset classes, including even sometimes esoteric ones. And that really led me to brokerage. People told me I was nuts. They're like, you have 2 graduate degrees and 10 years of principal side experience. Why would you do this? And to be honest, 10 years ago, I didn't have a great answer. But my gut told me, hey, go in this direction. Like somehow this is going to work. And 10 years and billions of dollars later, I think it's really worked well. And I love the job. I like kind of the process of helping clients, developers, owners, achieve financing for their deals and thereby scale their platforms. And so it's been a real joy doing this. And then about a year and a half ago, I started my own firm doing just this. So it's been quite a ride, but it's been a great one.
So I'm curious, how many lending institutions do you have in your cadre of possibilities?
Good question. So many. The answer is probably hundreds, and they span everything from banks to insurance companies to debt funds, credit unions, CMBS lenders, agency lenders, et cetera, et cetera.
So it just depends on the transaction as to which group you'll go to, it sounds like.
Correct. So the transaction profile, for instance, whether it's a recourse or non-recourse financing, the size, the loan to cost, the just sort of absolute dollar proceeds, interest rate expectations, term, all of those things are kind of going to dictate who the right lender profile is for the deal. And sometimes a deal can fit multiple lender profiles, and you really are creating a menu across, both banks and debt funds, for example, and kind of showing the client, hey, banks, low cost lenders, primarily recourse lenders, debt funds, primarily non-recourse lenders, and more expensive typically. There's always some premium for the pleasure of non-recourse and speed of execution. So what's a better fit for this deal? And that's very subjective. Depends on the deal specifics, and it also depends on the client's disposition towards those different lending sources. And each have their pros and cons, their mixed bag. So I guess lender selection is, in a word, very deal dependent.
So are the recourse lenders starting to get a little more flexible? What's happening over there?
Yeah, so very good question. Backing up, I think the real story in the debt capital markets for 2025 has been the return of bank financing. A year ago, and certainly 2 years ago, there wasn't much bank financing or recourse financing out there. There is today, and I've been saying that, like, 2 years ago it was like full recourse deposits,
Yeah, that was
very, very low leverage. And then now it's kind of like possibly no deposits anymore. And
wow.
we're getting partial recourse quotes in from banks. I predict that by the end of the year, banks are going to start offering non-recourse construction financing, which is something they haven't done since 21. And I don't mean like Bank OZK and Kennedy Wilson, who've been doing it forever. I mean, I believe regional banks are going to do that. And I'll tell you why. I don't think it's because they're necessarily so sanguine about the economy, but I think that they've had a few difficult years in terms of generating interest income and fees. And there's so much debt capital out there now that banks are
Right.
back. There's a ton of debt fund capital too, insurance company capital, and everyone's sort of like elbowing each other to win deals. And he who is most creative and most lenient on structure will probably win that deal. And so I think they're just going to be forced in that direction to keep up with the Joneses. So I don't think it's happened yet. I hear about it in pockets, but not yet thematically. But I think that's the next shoe to drop. I cannot tell you the amount of bank interest and bids we've had in deals this year that has rivaled only 2021. And,
Wow.
I'm working on a deal now where there are two banks neck and neck in a transaction. The parking garage deal that I mentioned, I don't usually finance parking garages. I finance lately a lot of retail and office and industrial and some multifamily and hospitality. But you've got two banks competing, and so far one of them is offering a 6.25% interest rate. And this
Wow.
parking garage does not have strong operating history. It's a turnaround situation. I think it's a good deal, but it's not like it has in place income that's underwritable. And we started at like 6.75, then a 6.5, now 6.25.
Wow.
All those rates are rates I never dreamed that this deal would be able to achieve. But to see two grinding it out over like something like this is remarkable. I do believe that that is kind of a broader representation of what is going on in the bank lending space today.
So are you seeing construction lending get a little better these days also?
Um, yes, there's a ton of debt capital available for construction lending today, which just wasn't the case a year or two ago. And that includes regional banks. I closed 4 ground up retail construction financings in Phoenix this year with regional banks, or 3 were with regional banks, 1 with a debt fund, and all of them financed beautifully, and all of them had a significant amount of competition on them. I'm an app on 3 multifamily ground up deals, 2 in LA and 1 in Santa Barbara, and those similarly had a ton of bidding and competition. Where construction is still difficult is on the equity side of the ledger. There still is very limited equity for new construction, and it makes sense in an environment where assets are being purchased below replacement cost. And so equity is sort of naturally diverting towards existing assets because why would you build if you can buy more cheaply? And so that still is difficult. But equity groups also monitor the debt markets closely. And most equity groups would prefer, all things being equal, bank financing to debt fund financing. And so a year ago, if you only had debt fund financing available or the bank financing wasn't super attractive, that was just another reason as an equity capital provider I might not be in the market. So today that reason is largely gone. Today, at least from a debt perspective, you can borrow cheap money from a bank, and that kind of makes sense now. Construction costs are still high, interest rates overall are still high. There's some uncertainty in the economy. All that's true. So I'm not suggesting that tomorrow the equity spigot for multifamily development turns back on. All I'm suggesting is a major impediment to that deploying, which has been lack of available bank financing, is gone. And that is positive.
Wow. And I assume you're not seeing any office construction going on out there.
Um, Not construction, no. I mean, you really couldn't find financing for office construction unless it's pre-leased, and like in Century City, and there's a tower going up here and it is pre-leased. So in those very unique instances, it works. Largely, it doesn't work. But office is another interesting story. A year or two ago, office really wasn't very financeable. And in
Right.
the last year to 18 months, it's become financeable. I've closed 4 office financings in the
Wow.
last, call it 18 months. And I'm just flew to Indianapolis for a fifth. And we just kind of gave a client guidance on a sixth. I was at a lender conference in Vegas, broker lender conference, a couple weeks ago, and many lenders, not all, expressed interest in office deals. And I think the thinking is as follows. The basis is obviously reset. Values are at historic lows. Um, and where you can show that the right office has like potential leasing velocity or in-place leasing velocity can actually be a really interesting asset class. And this is also a new thing and another sort of theme, I would say, of 2025.
But I think you're talking about refinancing an existing office building.
Correct.
Yeah.
Correct.
New
100% correct.
construction, new
There's
construction.
virtually no new office construction. There's
Yeah.
too much
Okay.
vacancy in the system to have it make sense.
Yeah. Yeah. No, well, I mean, given some of the fire sales out there on office buildings, I think that financing some of them make some sense now, right?
Um, Yes, I think for office assets, and I financed everything from a half-empty office building about a month ago in Houston's Energy Corridor, closed a $26 million loan, to about a year ago. I financed the purchase of 100% occupied, all post-COVID lease, new acquisition in Costa Mesa. And so I've seen both sides of it. You know, your pricing spectrum can be, as low as 6.5% on the low end, up to 12% or higher on the high end. So there really is a lot of sort of room in between. But broadly speaking, if an office asset has had a reset basis because it was purchased REO or something like that, and it either has in place leasing or you can show a pathway to it, and the sponsor is well capitalized and isn't trying to lever to the hilt, will invest money in the asset. I think office assets can do really well today. And I actually believe that's the generational or historic trade at the moment. I think that's the Sam Zell trade of our time. It's not easy, it's not risk-free. You've got big TI obligations potentially, and there's still a sort of hangover from COVID, hybrid work, work from home, and how does that all play out? But no guts, no glory. And so those guys that have the guts and really know their submarkets and are doing deals are doing great. I'll give you an example. This deal in India that I flew out to refinance. When the client bought it, it was probably two-thirds empty with a really large space. They bought it as part of a larger office park. And they have since or are about to sign a lease for it. And
Wow.
that's amazing. And they're going to end up with a 100% occupied building. So that's an interesting thing because that was I think office vacancy was something they looked at very skeptically of how would you ever fill it. And I'm not saying it's getting filled everywhere. There's certainly still some markets that are hit very, very hard, but it is getting filled in some places. And a deal like that went from two-thirds empty to 100% full, but has significant TILC and CapEx obligations, that's financeable today, and that's another very positive kind of bright note.
So it sounds like on that transaction, they bought all cash initially, and now that they have this 100% lease situation, they want to go back and get some capital.
No, it's an even better story. They
Oh, wow.
financed the purchase with debt, very expensive debt,
Oh,
because
okay.
they bought a
Oh,
5 campus portfolio that had significant vacancy. They've kind of been addressing the vacancy asset by asset. And here, what they want to do is extract that this property via a partial release provision into a new, cheaper loan, um, and a loan that will upsize the allocated loan amount because they've added a lot of value. So they're still going to have to put in some more money, but they're going to end up with a larger loan than they currently have in place. and a cheaper loan than they currently have in place. So that's a really good example representation of how much the markets have tightened, because same scenario a year ago, maybe they would have to stick with their existing lender and just fund all the additional obligations cash. Fast forward a year later, they're like, we don't have to do that. We can take
Wow.
this out, find cheaper money, and find more money. That's an amazing thing to witness over the course of a year.
Wow, that is fantastic. So, given the fact that there's so much capital out there, it sounds like with the competition that's going on, that interest rates are kind of creeping down a little bit.
Yeah, so that's a big part of this, and I don't think that can be understated. It's a great point. 3 years ago, we were kind of staring up Mount Everest, right? You knew a lot of interest rate hikes were coming, and you kind of didn't know where it was going to end. Now I think we're sort of on top of Mount Everest, so to speak, and now we're looking down, and we don't know how long the descent is going to take, how steep it's going to be, but we know that it's coming, and imminently, and I guess like probably tomorrow, at least the beginning of it, and that I think will be a very positive thing. So yes, it is, put in different terms, much easier to justify an investment in a declining interest rate environment than an increasing interest rate environment. That's for sure, and that's got to be on everyone's mind.
Yeah, no, that's very interesting, and hopefully it'll do the stimulation that it needs to. And I'm not sure if we should talk about all the other elements involved, but we can kind of go into what tariffs might potentially do, but that may not be an area that is really going to affect lending that much.
Right, right. That's a very good question. I can tell you people were scared when Liberation Day happened. Not a political statement, but the volume of new deals, new financing requests, which is a barometer, not the only barometer, but one that I follow pretty closely, plummeted when Liberation Day was announced early March. And then when the reprieve hit, I think in kind of late April, early May, deal flow came back to life. So there was a real jolt to the system. There are open questions as to what degree will tariffs be inflationary and specifically impact like construction costs, because I think that's where you see it hit hardest, or impact industrial real estate, where manufacturing, distribution, import, export can be a thing. Nobody really knows. So far, it doesn't feel like a lot. So far, I can tell you that on a number of projects, I've actually seen cost de-escalation. So I've seen cost declines anywhere from, 5 to, in one case, 15%. I think that's an
Wow.
outlier, but I think 5 kind of sounds right, maybe 10. So that would, I think, indicate lack of inflation. And look, that makes sense to me. There's so little equity available for development. That means that projects aren't getting started. If projects aren't going to get started, then there is capacity in the system that is growing every day. And so it would make sense to me that the cost of labor and materials would decline as a result of that. Now, if things with China get like crazy again, who knows? But so far, I think the fears have been, uh, I don't think have come to fruition, let's say.
Well, let's keep our fingers crossed. I'm very interested in this. I know you have a hard stop to go to, so I want to reconvene probably in 3 to 6 months and probably
Sure.
address this exact idea and see where
Happy
interest
to.
rates are, where tariffs are. That would be very intriguing. So let's put that in just for fun. Let's end with what your favorite food is.
Oh my gosh. So I'm a meat and potatoes guy. So favorite food is either burger and fries or a variant on that, just like steak and a baked potato.
All
So
right, all
I'm
right.
I'm easy.
And who do you want to sit and eat that with? I know we talked
Uh,
about this earlier, but I your answer was great.
um, so the short answer is Roger Federer. A little bit longer answer is I got invited to a forum that had him speaking Friday last week, and I couldn't make it as I was in Indianapolis. I'd love to get a burger with him. Seems
All
like a
right.
really,
All
really
right.
great guy.
Well, as I said, when that happens, let me know. I'll fly down and join you.
Will
So
do.
great to have you.
All right, likewise,
I
Bruce.
look forward to talking to you again in probably the new year. We'll reconvene.
Sounds great.
All right. Thanks
Take
so much.
care.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.